Welcome to the Market Report Show of today. I am Adefolayan Olamilekun. On the Market Report Show discussion segment, we'll be looking at strengthening investors' confidence on the Nigerian equity market. I'm already having standing by to join us on the discussion section, Mr. John C. Chukwu, the CEO of COWRY Asset Management Ltd. Mr. Chukwu, a very good day to you, sir.
Thank you. Good day. Thank you for having me here.
All right. Thanks. We are so pleased to have you on the show. Sir, let's quickly, I know you have another serious meeting after now. So let's quickly run through our discussion segment, particularly looking at Nigerian equity market. Take us through what has really happened, because we have discovered that since 2020, there has been a remarkable performance from the Nigerian equity market. What really happened? How do we get to the level that we have gotten today?
Well, a couple of factors have driven the Nigerian capital market in the past four years. One, if you start from the period in election 2020, there was an election in 2019 that signposted a continuity in governance or government by the then President Buhari, which eliminates or reduces the political risk associated with the transitional period. And also bear in mind, in 2018 and 2019, the market suffered contractions or decline, about 17.8% in 2018 and about 14.6% in 2019. So part of the 50.03% we saw gain in 2020 was partly to recover the losses in 2018 and 2019, and that also as a kind of vote of reassurance by investors that look, we have gone through a transition period, and then there was no concern, the political risk had moderated. The same thing, if you look further down, then you saw a market that gained the region of 6% and what has been the two intervening period between 2021 and 2022, and I think about 16% or so. And then in 2023, we saw a market that reacted to a presumable or supposedly market-related economic policy of the government. You saw the government came into power, deregulated the downstream oil and gas sector, particularly fuel prices, deregulated power supply, deregulated the exchange rate, and market investors actually responded positively to that. So we saw a market that gained about 45.9% in 2023, all in response to one, a successful political transition. Two, an economic orientation that was now focused on private sector-led economic thinking. And then last year, we also saw the market took the benefits, part of the benefits of that excitement about a market-related economic philosophy. As of January last year, 2024, we saw the market gain over 35%. Eventually, at the end of the year, the market gained 7.65%, which means most of the gain was actually done in January because the market also reacted negatively to increase in interest rate, particularly starting from the month of February, when the central bank increased the treasury bills rate to the region of 18%, and the market reacted negatively because investors began to shift from equity instrument to fixed income instrument. But last year, as we approached toward the end of last year, we saw performances by quoted companies. Their half year and third quarter performances posted good dividend payment at the end of the year, and investors had to go back to the market. So in effect, in summary of what I've said is that the market responds to one, political and economic outlook, two, policy pronouncements as it relates to economic policy pronouncements, three, the interest rate environment, as well as inflation and other factors that drive interest rate.
Very fantastic from you, Mr. Chukwu, and I really love the way you precisely put all the data that come all through. You know, we are so much interested in the 37.65% that was recorded by all shares index last year, 2024. But I want to ask this question. The regulator, SEC, and NGS, how has the engagement with stakeholders like you impacted the sector, particularly the market, going forward?
You know, one of the things that you expect the regulators to do is to instill market confidence. And market confidence that the regulators must have zero tolerance for breach of market rules. So if you look at NGS, for instance, you've seen suspension of the trading of some stocks that are not publishing their quarterly and annual returns on time, that are failing to render their returns to NGX. So you see suspension on their shares. We've seen delisting as authorized by NGS for companies that are in eventual breach of market regulation or post-listing regulation. So that gives investors the confidence about the integrity of market, about the technical information they have, about the reduction to the balance minimum of insider trading. And then we also see SEC, Securities Exchange Commission, drive enforcement as it relates to market operators as well as quoted companies. These are some of the most important things that investors are looking for from regulators. The investors are looking for transparency in the market. They are looking for zero tolerance for infractions in the market. So that gives them the confidence that the investment is secure. Not that the investment is secure, that the judgment they make based on market information is objective and is up to date, and that nobody taking advantage of insider information and manipulating market prices.
Very interesting. Now, another very interesting aspect of the market, which many investors will be much be aware of or try as much as to get more information, is the policy of the Central Bank of Nigeria. You have made mention in your comment as you start that the policy of the government, the policy economic, although now I want to look at the policy of CBN, particularly how CBN have been saying they want to fight inflation. Do you agree with some of the instruments that have been throwing out to fight inflation? Because as we speak right now, inflation is still very high. I know above 30%, that most of us have been looking down that it will come down to 24 or 25 that the government is projecting.
You know, the challenge that the central bank is that they need a very difficult macroeconomic environment. In the first place, if you look at last year, 2024, the central bank and the DMO withdrew more than 33 trillion naira from the economy, all in a bid to increase liquidity injection into the economy. At the same time, as at November, FARC had injected over 14 trillion into the economy, thereby counterbalancing some of the measures that the central bank was taking. But beyond that, the issue that the driving inflation are structural in nature, and therefore the effectiveness and use of monetary policy in fighting those factors is highly limited. Take for instance the issue of food inflation, which is one of the obstinate and more difficult ones to fight. Food inflation is driven by insecurity in the country, where the food base of the country are difficult to go to farms and produce, where people have to pay taxes to go to their farms, people are kidnapping their farms. So you have a lot of people in the north central, northeast, northwest, living in internally displaced persons camp, not able to go to farm, not able to produce enough quantity of food that we used to produce. And that is driving up the food prices. So there is no amount of interest rate increase that will make people not to use whatever is left in their pocket to buy food. Because remember, consumption of food is like what we may call non-discretionary for households. They must feed themselves. So fighting food inflation from interest rate perspective is almost impossible to achieve any tangible result. The other factor of driving inflation is the issue of exchange rate, partial effect of exchange rate devaluation. Once prices of goods and services move up because the landing cost converted to naira has increased, the merchants who bring in these goods must price them at exchange rate, living exchange rate. So there's no amount of increase in inflation, interest rate that would drive that. What you can only do is cut down on consumption, the volume of goods consumed. But also bear in mind that because we don't have consumer credit, the transmission channel for monetary policy is also very weak in the country, because the estimate in the world through consumer credit, when the interest rate goes up, people are not able to borrow at those high exorbitant interest rates to consume. But most people are consuming from their equity, from their personal savings, from their income. So increasing interest rates. So what I'm saying in effect is that central bank have a primary job to maintain price stability. But unfortunately, the tool they use here is not as well developed as you have in other countries in terms of transmission channel. Secondly, some of the pressure they are getting, some of the factors of inflation are structural in nature. So that's why some of us have said to CBN that deploying the wrong tool to fight inflation attracts unintended negative consequences, including constraining these sector productive activities.
Very interesting. Now, you know, Nigerian equity market is quite strategic, very vibrant and dynamic in entity. But there's one particular sector in the global economy that is also very vibrant, very dynamic, very uncertain, very fluctuating, which is the global oil price. How do we see this affecting equity market in Nigeria? Because a lot of investors also look at that direction before they make informed decision on coming to the market.
You know, for investors, local investors, for instance, what they look at is if crude prices are high and Nigeria is able to produce sufficient crude, then it will lead to stability in exchange rate or stability in exchange rate or improvement in exchange rate. So that will mean that the Naira vote, the Naira investment, at the minimum will retain its value. And then they are only dealing with capital gain or capital loss. But if they think crude production is going to be weak, which means Naira is going to devalue, if Naira is going to devalue, your investment in equities, if you convert it back to the real value of that amount you have invested, becomes eroded. So a factor that investors actually consider, local investors consider in deciding whether to invest in any class of local currency assets, including equities. As it relates to foreign portfolio investors, they are also looking at what is the liquidity in your FX market, so that whenever they sell their stock, they should be able to convert back to dollar and exit. If your crude sales are weak in terms of either crude production or price of crude globally is weak, they become worried about the liquidity of your foreign exchange market as to allow them exit from the market. So if crude production is weak or exchange rate or crude price is weak, it serves as a disincentive for both local and foreign investors to invest in any Naira asset class in Nigeria.
Very interesting for me, Mr. Chukwu. Now, another very key aspect of our discussion is let's now focus on investors themselves. You know, there are a lot of information out there on how investors can come into Nigeria, but strategically, investors need concrete information, and they must be able to make informed decision when it comes to where can they get this? You know, you have been in that sector for a very long time. So how do we advise our investors, either local or foreign, on the right way to get information that is very good for them and find a platform that will invest their money in the equity market in Nigeria?
Okay, what I would say is that depending on the class of investors, if you're talking about retail investors, the channel of information available to retail investors include the NGX website, where they can see market performances. They can also see a lot of statistical data, economic data on the website of Nigerian Bureau of Statistics. And then to really to do a deep dive, they can also talk to people like COWRY and any other investment bank that have research units, robust research unit like COWRY, where information can be synthesized and provided to them. And a lot of people who invest or who trade through known market operators will ordinarily have information at their beck and call. For instance, we provide daily market information, we provide weekly market information, we provide recommended stock, and I believe a lot of other operators also provide the same thing. But I always advise retail investors to get an expert to handhold them in making their investment so that they can have access to relevant information. For institutional investors, some of these institutional investors have their research units. They carry out basic research to have information on, because they also stake a huge amounts of money, so they need to have information at the tip of the best information they can have. Many of them have research information. Some of them also subscribe to research information produced by the likes of COWRY and other entities.
Very interesting. Now, there is this issue about diversification in investment stream in Nigeria, particularly on equity market. Can you take us through what it means when someone coming to Nigeria or local investors looking at diversification so that you can manage risks? What does it really entail because of investors, whether locally or internationally, that are coming?
Well, diversification entails separating or investing your portfolio in multiple asset classes that have that do not have similar risk. And what I mean by similarity is saying that, for instance, we always say to people that the movement in fixed income instruments is in opposite direction from movement in equities. So in making your investment, to moderate your risk, to manage your risk, you have to, one, if you look at an asset class, you also make sure you don't have all your portfolio in that asset class in a single asset instrument. It's a single instrument. For instance, if you want to invest in equities, you make sure you don't invest only in one stock. Not only you don't invest in one stock, you don't invest in one sector. You spread your investment into different sectors. Take, for instance, the oil and gas sector, the banking sector, the agricultural sector, the consumer goods sector, the industrial goods sector, because they may not move in the same direction. That's one aspect. Two, you also make sure that your portfolio has other asset classes. Take, for instance, real estate investment in fixed income instrument. And if you want to do investment in fixed income, you look at commercial papers, you look at federal government treasury bills, depending on the size of your portfolio. You are looking at money market instrument with banks, and you also set your limit for each asset, each instrument and each asset class, so that any movement in a negative movement in each asset class does not completely erode your wealth. One of the principles we have always emphasized that do not bet your entire balance sheet on any asset, on any single asset, no matter how viable or profitable that asset class looks.
All right, very interesting. You know why I asked this question was that last year equity market performance, we saw the consumer goods performing wonderfully well. We also saw the oil and gas, doing greatly well. But we also saw the financial sector, striving, and nobody can doubt the performance of the financial sector in the Nigerian equity market. And that's the reason why I asked the question. But going forward into the discussion, on the other angle is the issue of how Nigerians, local investors, can be able to identify some of the key choice areas. Although you have mentioned, you can diversify from different sectors, but ensure that the negative aspect of it doesn't affect any of your investment, so that it can be above the risks. Now, looking at the policy of the government once again, particularly the forthcoming CBN MPC meeting, what is your view about the next coming February 17 MPC meeting that is coming? Because a lot of analysts like you have been projecting and also asserting on what they expect, whether a dovish or a hawkish stand. What is your stand on the next MPC meeting coming next week?
Okay, let me start from the first part of your question, which is how would investors make their choices, decide what to invest, and understand what could happen in their investment. We always advise that people should start from the macroeconomic outlook. What is happening in the economy? Then you go to the sectorial outlook, what we call top-bottom approach. You go to the sectorial outlook. So you look at the sectors you want to invest in, you look at those sectors. You just did mention some sectors that did excellently well last year. So if you have done your market study and look at those sectors that have both strong performance potential, you now look at it. Then you now go to the individual instruments within those sectors. So if you do that way, you're likely going to make choices that are sound, that are objective, and that could give you good results. But back to your second question, what's the outlook on the Monetary Policy Committee? I think today we're dealing with inflation rate about 34.8%.
Exactly.
Efforts by the central bank to drive down inflation rates. We are dealing with a GDP growth about 3.46% in the third quarter of last year, of which was largely fragile, because if you consider that the major drivers of the GDP, which is agricultural sector, which can account about 28% of the GDP, grew by 1.14%. The likes of manufacturing sector grew by 0.9%. Trade grew by 0.6%. And these are the big hitters. These are the major contributors of the GDP. It's only telecommunications sector that grew about 5.8%. So that shows that if anything happens in the telecommunications sector, we could see a decline in GDP in terms of share of weight. So that means our economic growth, though at a rate of 3.46% last third quarter of last year, is still very fragile. So the Central Bank Monetary Policy Committee must decide what should be of priority. And like I said earlier, fighting inflation by further tightening have not been effective. So my approach would be, since we are now dealing with, obviously, we're going to have a rebased GDP. We have, the government has come up with a 54.6
trillion naira budget.
Which means that we're going to have an expansionary budget. But I think if I were to advise them, I would say they should hold, they should not tighten further, and watch the economic performance of the country, and watch for the fourth quarter GDP figure and full year performance of the economy in 2024. And I will help them make more informed decision on what direction the interest rate inflation will go, and take a decision that will not hurt the lead sector of the economy, neither will it exacerbate pressures on price levels and the exchange rate.
Oh, thank you so much, Mr. Chukwu. I am almost tempted to ask you this last question, although you chip in when you're answering this one. The budget, 54.6 trillion. What's your view? Quickly, sir, so that we'll have a time for you, sir.
My view is that budget is extremely optimistic. I don't government should have increased it further. We're already dealing about 13.3 trillion budgeted deficit, which certainly will be above that because the projected revenue will not be achieved. If you look at revenue about 13.6 trillion coming from oil and gas sector, it's almost impossible. We have seen the price drop last year to below $75. They have moved back $75 today. We know that our crude price in 1.4 million barrels. There is a provision of about 2.06 million barrels a day, which means our revenue estimates are overly optimistic and not achievable. So if now expect that more revenue will come from Nigerian Ports Authority, from Nigerian Customs, from Federal Inland Revenue Service, what we should do is to have applied that revenue to reduce the deficit, the projected deficit, so that we do not borrow much more this year that will further compound our fiscal condition.
Oh, thank you so much, Mr. Chukwu. I hope I will soon call on you very, very soon because fantastic rendition of the statistics that is within the equity market and outside is very robust for this kind of discussion that we have just had. Thank you so much. I want you to enjoy the rest of your day in Lagos, sir.
Thank you for having me.
All right, sir. Thank you so much.